Hey guys, what's up? Alec back with the daily stock market, and today what we're going to talk about is 7 different stocks that are going to be value-based stocks to own for the long term and some good ones to consider buying during the dip. They're not going to be based around hype. These are going to be 7 value stocks to have on your radar for the next couple months to be dollar cost averaging in slowly. Remember, don't buy in all at once because, as you guys know, the dip can keep dipping. So make sure you always keep money on the sidelines and establish a personal, comfortable budget for yourself so that way you can average yourself in the market consistently over time. So with that being said, a first one on our list is going to be Google. All right, GOOGL, or you can even buy GOOG. There isn't really much difference at all except for you get like voting rights with GOGL. That's why I like the Class A, so they're basically the same thing. And from its all-time high, it's down around 13%. All right. This is one that we can see a big dip on. All right. We haven't seen Google and some of the other ones that we talked about on the list on this list drop just yet. But if these head towards 52-week lows, I definitely want to keep some money on the sidelines for stocks like Google and other ones that we talk about in this list to drop to 52-week lows. All right. So with that being said, I want to get in Google below $2,000 per share. As you can see, my average cost is $2,800. I only have $200 in Google though, so it's not much of anything. We had a reoccurring investment for Google, but I'm waiting for more of a big dip. We see the market cap at around 1.7 trillion and a PE ratio for a big tech FANG stock of 25. Anything under 30 for big tech FANG stocks, I think is a great PE ratio, showing that we're not overpaying for the profit that Google's making. And if you guys don't know, it's basically like every dollar of profit they're making, you're paying $25 with a PE ratio of 25 for every $1 of profit that Google makes, which is actually pretty good. You know, typically you want to see below 30, but nowadays we see companies with PE ratios above 50, above 100, and people still eat them up and buy them like crazy. Like Tesla, for example, and I think that Google is also going to be a good advertising play over the coming years. People are going to up their advertising budgets as people keep realizing that YouTube and Google are the 2 biggest search engines in the world, and that's where all the eyeballs are, and people want their business on the front page sponsored, whether it's YouTube or Google, because don't forget, Google does own YouTube. Right, so the next one on the list is Amazon, ticker symbol AMZN. Everyone knows them, everyone loves them. Now, this one could be argued that it's more of a growth stock than a value stock, but I'm going to make the argument today that it's going to fall into value territory. So it currently might not be sitting at value stock territory, but as soon as Amazon, you know, if it does fall below $2,200 per share, and into the 1900s, 2100s, even 2200s, I think that's when we start to see more value behind something like Amazon. Here we can see I only own 0.7 shares. This is for long-term holding, and I want to triple or even quadruple my position in Amazon over time. It's probably going to take some time to do that. Right now I'm buying it at $10 per day. That's how I've accumulated over 0.7 shares of Amazon. However, I want to see that market cap under 1 trillion, closer to 900 billion, and I want it, which probably actually won't happen, to probably get closer to like 1.1 to 1.25 trillion. That's probably a more realistic market cap. But my point on Amazon is I am looking for a little bit more of a dip before I start aping into something like Amazon. All right, we see a PE ratio of 55 still on Amazon, which is, remember, Amazon is considered a growth company to a lot of people. They have great guidance. As you can see, they've been growing their net income consistently, double digits every single year, and they've been growing it to as high as 83% gains year over year growth, most recently in 2020 with 21 billion on their net income. And they've also been a revenue monster. So typically, you know, value companies aren't putting up numbers and growth like this in revenue and net income. Look at that revenue growth. You'll be hard pressed to find 30% on average year over year for the last 5 years. A company like that is considered a value company. So that's why a lot of people wouldn't consider it a value company, consider it a growth company. And that's also why you can pay a little bit more on the multiple. That's why the PE ratio could be justified. We see the forward PE ratio higher, close to $69 or 69 on the PE ratio. We also see the price to sales at 3, which again is pretty high. 3.9 price to sale and 11.9 price to book is pretty high when it comes to value investing. So we want to see those specific numbers. PE forward, PE, PS, PB ratios start dropping a little bit to get a little bit more of a value play on Amazon. And if you guys want to understand how to read those terminologies a little bit better, I have a program and a course that actually breaks it down into layman term so you can become a better investor in the stock market, take the bull by the horns, and start having a bull market going on in your portfolio. So message me on Instagram if you're interested in getting in that course. I have one-on-one programs as well with a close friends list. If you want to see all the different moves I'm making, what individual stocks to actually beat the stock market. Now, if you want to take a little bit more of a safer approach, or if you don't have anyone to lean on, for example, or anyone to talk with, or you don't think you're that good at picking stocks, then this next one we're talking about, it's going to be an ETF. However, the ticker symbol is VTI and can be found on most people's brokerages. This is the Vanguard Total Stock Market ETF, and it returns consistently over the last 20 years or more. You can actually pull this ETF up on your own time and see that it's one of the oldest ETFs with most of the consistent growth in the stock market out of any other ETF or any other stock over the last 20 years. If you don't know about it, it's one you should definitely get familiar with, especially if you expect to be in the stock market for a long time and you like to just set it and forget it, buy it and hold it for long term. This is a good one to get familiar with. Now you can see the number of holdings, 4,000. Wow. But this is the most important thing right here is what's in the fund. It's 26% technology, 13% healthcare, 12% financial. So it's kind of very similar to the S&P. All right. You can see the top 10 holdings, which is the most important part too, because the top 10 makes up around 20%, of the entire fund's holdings. So you can see 5% Apple, 5% Microsoft, 3% Amazon, 1%. 1.8% Google, 1.7% Tesla, so on and so forth. This is a great one to be involved with. You can see assets under management, 276 billion with a 28 PE ratio, right under that 30 PE ratio, which is nice. And they also have a 30-day dividend yield of 1.1%, which is another great thing to realize that you are investing into a dividend stock when it comes to VTI. With that being said, I don't know if you guys know, by the way, the S&P 500 is down around 11% year to date. And you'll also see the VTI is down 11%. So it pretty much follows pretty evenly. I want to see VTI at a 52-week low before I start loading up on VTI. I want to see them under $200 per share, which I definitely think is possible, especially with this market crash that we're seeing. We can even see a market rotation, which means that, these big stocks that haven't got hammered yet, like the ETFs, the value stocks, Apple, Google, Amazon, those kind of stocks haven't got really hammered yet, but we can see them starting to get hammered, and we can see the stocks that already got hammered, like the low market cap stocks and the growth stocks, start returning and start actually coming back up into the green while the market rotates. These value stocks could get hammered. So watch out for 52-week lows on some of these value plays. All right, so that brings us to our next stock, which is Procter & Gamble, which is on the list. Again, you're going to want to wait for dips on these ones. You can see it's up 13% in the last 3 months. You can see that it's at a 52-week high. It's at an all-time high also, basically. So the good thing is why I'm making this video is because we can start to see these stocks getting hammered. Like I'm saying, we can see the market rotation kick in. We can see these stocks get hammered, and Procter & Gamble, for all we know, can go back down to $120 per share, $130 per share, which is my buy point. Anything under $130 per share for Procter & Gamble, I definitely want to be loading up on for long term. look at when this was founded, by the way, 1837. Holy cow, in Cincinnati, Ohio. And they're, operating in the beauty, grooming, healthcare, fabric, home care, baby, family care type of thing. So I think that these things will always be in demand even during a recession, is why there's value in the stock, consisting of female and male razor blades, shaving products, appliances, healthcare segments, oral care, toothbrushes, toothpaste. People are consistently buying this kind of stuff at all times. Dish detergent, laundry additives, baby wipes, pants, and paper towels. And PG, Procter and Gamble, owns some of the biggest brands in those spaces. With a market cap of 395 billion and a PE ratio right under 30. This is one you definitely want to have your eyeballs on, and a dividend yield of 2%. This stock made our dividend investing video. If you didn't check out our dividend investing video, that was the video right before this one. So check out that video if you haven't already. And if you guys are having a good time throughout this video, make sure you smash the like button so we can actually spread the word and more people can see these videos. Here we have Verizon as our next stock. And in the last year, it's down 7%. This one consistently doesn't move that much, so it's a good value-based stock that's almost like cash. However, you get a huge dividend on it. Here you can see I have a large amount in Verizon because it doesn't move. Like I said, you get paid a dividend. It's very liquid, and you can count on Verizon not crashing like 20% on you or 10% or anything like that in one day. It just won't happen because it's a very stable and liquid stock, in my opinion. Now, never say never, because anything could always happen. This one's on my radar for a 5-year support. I want to get in under $45 per share. And if we see this one under $45 per share, I think that I personally will not want to pass that up, especially my dividend portfolio. You can see that this one pays nice big dividends. Here was a $44 dividend that I actually got on Verizon, which was awesome to see. I love when I see my dividends coming in. So if you have a big chunky portfolio in Verizon, it has a nice dividend of 4.7%. And it has a very attractive PE ratio of 9. So far, this is the lowest PE ratio on the list, which is proving and backing up that it is such a fantastic deal at the current price. You also see a 52-week low at 49, so it is getting to that 52-week low. I want to see it under that 52-week low before I start buying huge chunks more of Verizon. Now, PayPal is the next one on the list, down 5% on the last trading day, which was Friday. So that is pretty concerning. Now, PayPal's kind of like Amazon. It's one of those stocks that could easily be classified as a growth stock. All right. But with this huge dip that we're seeing from PayPal, it's going to be entering that value zone, that value stock territory pretty soon here. So if we see PayPal under 150 to 125, that's going to be value zone in my opinion. Do see a small support here right at 156, by the way. So that might be the support that PayPal is currently holding on to. However, the support that it was following between November 30th and January 6th was a pretty strong support. It recently broke that, so watch out for PayPal to go a little bit lower. And if you have a large position in PayPal like I do, for example, then doing puts to make that $400 back that I'm down on PayPal right now could be a good idea, for example, and you'll still have that equity and that value built in, so you don't have to sell some of your shares of PayPal. We also see a PE ratio of 39 on PayPal. So like I said, it's getting close to that value territory, almost under 30 PE ratio with a forward PE ratio of 35, which is again very attractive. Let me show you why paying a 39, 35 PE ratio on PayPal isn't the worst thing in the world, because if you look at the net income, look at that consistent growth. Wall Street loves to see that net income growth, and you cannot argue that net income growth is beautiful, going from 1.4 billion to 4.2 billion in 5 years, well, really like 4 years, okay, with 40%, 18%, 70% net income growth consistently year over year. If we go to their total revenue growth, they've also been growing double digits consistently from 2016 to 2020 without a misstep. Wow, that's so unbelievable. Typically, when you pull up a company's 5-year revenue chart, there's always at least like 1 year where you see a hiccup or a down year or slower growth or not double digit revenue growth for at least 1 or 2 years. But all 5 years are consistent growth for PayPal, being tremendous value in my opinion when I'm looking to buy a stock. If we scroll down to the balance sheet, we also see that, well, actually, let's take a little bit more of an updated look of what's going on. So their cash and cash equivalents is 7.7 billion, which is up 27% year over year, which I really like to see that. That's very, very attractive to me. So here's the important number. Total assets, 74 billion. And you can see that is up from 4 billion from 2020. And then there's one more number that we want to look at least is going to be the total liabilities, which is 52 billion, which is only up 2 billion. So yeah, their balance sheet isn't the worst thing in the world, isn't the best thing in the world, but their total revenue and their net income, in my opinion, justify paying a little bit more on the multiples or the price to book, price to sales, PE ratio, and that sort of thing. Puts might be interesting on PayPal that I'm considering. However, it seems like we are pretty much bottomed out. But as we can see, the dip can always keep dipping. That's why you guys always hear me preaching all the time. Have money on the sidelines. Always have money on the sidelines so you can continue to buy the dip. Just in the last year from a 52-week high, by the way, PayPal is down 50%. So long-term investors could find huge value in that if you plan on holding, for example, for 5, 10, 20 years. I know a lot of you guys have IRA, 401ks. So PayPal and some of the other ones on this video on the list might be a good idea to start sticking some of these stocks in those long-term accounts. And like I said, the most important thing about this video too is especially if we keep seeing a dip. So like I kept saying throughout this entire video, if the stocks, if PayPal, for example, goes to 150 and other stocks on this list start dipping 10, 20, 30%, then I might consider going into margin or even taking out bigger positions. And if you guys want to learn more from me and about margin trading and you want to see my buys, what I'm buying, what I'm selling, how much I'm buying, when I'm buying, make sure you message me on Instagram. I have a fantastic program that gives you full access to all my close friends list. Here you'll see all the green posts. Those are all close friends access. So I post a ton. You get at least 3 posts per day, sometimes up to 5 posts or more per day. All right, you'll see success number 4. If you go through that, you can see the success, over 500 positive testimonials now with student success that have been happening. If you want to read a little bit more, click success number 3, success number 4, success number 2. There's plenty of success stories to go around. So if you want to make 2022 your year to dominate the stock market and learn to invest in your future and learn what a PE ratio is, PS ratio, how to read income statements and balance sheets, make sure you message out to me. I'll be more than happy to take you under my wing and help you out, just like I have hundreds of other students that have signed up in the past. Don't forget to share with a friend, like this video, subscribe with post notifications on so you don't miss any videos and you get alerts anytime I post a new full-length video. All right, guys, I'll see you in the next video. Remember, don't time the market, buy the market. Peace.